Welcome to the Farms.com Risk Management Educational Grain Commodity Market School video series. This video series being brought to you and sponsored by DeKalb Brand Seed to educate producers and farmers across Canada about grain commodity marketing. You can find us at www.marketschool.farms.com. Well, this is our actual last video, our 28th video. It's part 2 of putting it all together for you that we did last week in part 1, and we're going to continue to recap and summarize all of the videos of 2011. We're going to continue to tell you what to watch for and look for in the future so that you too can stay ahead of this so-called marketing game. Again, I like to say that finally marketing can be fun, can be simple, and can be successful. So don't overlook higher crude oil prices. We've been talking about what to watch for and what to look for. Another one is crude oil prices. Higher crude oil prices mean higher ethanol prices. We got a situation, some tension in 2012 with Iran that could pose problems for crude oil prices, could drive corn prices higher as well. Higher ethanol prices equals more profits, more corn usage. Keep an eye on those ethanol usage numbers. Watch U.S. corn prices for direction. The U.S. corn is the king. It's the driver. Everything else seems to follow. A rising boat lifts all tides. So if corn's going up, despite weak and bearish fundamentals on wheat, wheat's going to rise with corn. The cure for high prices is usually high prices. So when we're very high, be careful. Ask yourself, what's your risk? What's your reward? Don't forget to watch USDA reports. When ending stocks, like you can see on this chart here, ending stocks down to that 800 plus million bushels, it's a very tight number. Once the USDA starts to drop those numbers, once they start to drop average yields in the US, that trend usually will continue. Try to project forward based on acres and trendline yields. Understand the past can help you provide a glimpse of the future. Watch U.S. corn prices for direction. Again, they're the king and they're going to drive prices forward. Usually the cure for high prices is high prices, I mentioned earlier. Understanding whether that's a weather rally being caused by a weather rally, a demand market, or a supply shortage is also critical. Weather rallies can come and go. They can evaporate fairly quickly. They can evaporate faster than they were created. We always take the stairs up, but we always take the elevator down. So try to avoid taking that elevator down. There's nothing like a weather rally. Prices are driven by supply shortages. Any production problems due to weather locally or internationally can cause prices to rise. A good example was 2010 Australian floods, or even the La Nina weather pattern here in the last couple of years in North America, causing either spring floods or dry weather through the summer. It's very difficult to trade weather markets, but technically speaking, when those markets are considerably high due to fear, maybe it's time to take some profits off the table. Understanding market psychology, I think, is also half the battle. Understanding that fear and greed can take markets to extremes. They typically will fall back to a medium or an average when the future price is well above that 200-day moving average at seasonal peaks. Funds are long, news is factored in. I think it's time to sell, sell, sell. The very opposite is also true. Your future marketing plan should largely be focused on fixed forward contracts. We've talked about that in past videos. Futures and options should also be part of that plan, kind of your backup plan. However, the 2011 MF Global bankruptcy has left a sour taste and a black eye in the farming community. So to avoid having all your eggs in one basket and to manage your risk, I would suggest opening up multiple accounts until a futures and options protection fund is created. Studies have shown that futures and options work when prices are historically very high. Futures should only be used by sophisticated farmers who understand the risk and can muster the margin calls, the daily volatility, and can sleep at night. Options are less risky when protecting unhedged bushels into the future. Only use a broker to execute a trade, not for advice. Keep your hedging account separate from your speculative account if you plan on opening one. Choose one person to pull the trigger to execute that plan, one that preferably has a passion for marketing. Both futures and options should still be part of a small part of that marketing plan unless you plan to use storage bins. Don't get caught with empty pockets. Everything in moderation is good. So a combination of storage bins, futures, options, and fixed forward contracts is good. Arm yourself with the information, the know-how, the tools, and you too can become a marketing expert. Never panic, become less emotional, and do not chase a falling knife. You've seen markets where they just keep falling and falling. No need to panic, no need to chase that knife. Be patient and buy some time to allow markets to heal or find a bottom. Understand what outside markets like the European debt crisis in 2011 means to your bottom line. That is also important because it can affect the direction of prices. Identify some chart patterns. Technically speaking, use the four-day trading rule to identify a change in trend. 4 lower closing lows after a big rally could signal a change in trend and vice versa. When markets are crossing below the 50, 100, 200-day moving average, that could signal, that's a very bearish signal, or it can go the opposite way, which is very bullish. Studies have shown that after a big advance or decline, markets will retrace 32, 15, 62% of the previous highs or lows. Identify other chart patterns like double tops, triple tops, double bottoms, key reversals. So you can see from this chart here, I've identified some double bottoms, the 4-day trading rule, Fibonacci retracement. Moving average crossovers are also very bearish if it's to the downside. Luck should not be part of any business plan. Try to ignore the noise, because there is a lot of noise out there, and it's never as good or as bad as maybe the media is portraying it. I will end with Boone Pickens' old saying. He's a U.S. oil tycoon, a famous oil tycoon, saying a fool with a plan will always beat a genius with no plan. Don't forget to ask yourself, what's your risk, what's your reward when you're at market highs? In summary, it's been a pleasure. It's been a long journey. I hope that I've inspired you, educated, and entertained you along the way. Risk is not knowing, but now you know. Don't forget to do some marketing, manage your risk, manage your volatility. What is your marketing plan? Thank you for spending time reading and listening to all our videos on how we can all do a better job of marketing grain better. I would also like to thank my team members and our sponsor DeKalb for helping me put these video series together. We hope to bring you more educational videos in the future. Till then, thank you.